Chapter 16, the monetary system. In this chapter, we will answer the following questions. What assets are considered money? What are the functions of money? What the types of money? What is the Federal Reserve System? What role do banks play in the monetary system? How do banks create money? How does the Federal Reserve control the money supply? So, what's the meaning of money? First, let us define barter. Barter is an exchange of one good or service for another. Barter requires a double coincidence of wants, and unlikely occurrence that two people each have a good that the other wants. It wastes resources. People spend time searching for others to trade with. Using money solves these problems associated with barter. So, money is defined as the set of assets in an economy that people regularly use to buy goods and services from other people. Money has three functions. 1, medium of exchange. 2, a unit of account. And 3, a store of value. Money can be distinguished from other assets. Let's look at them one by one. Medium of exchange. An item that buyers give to sellers when they want to purchase goods and services. The second function is as a unit of account. That is, money functions as a yardstick people use to post prices and record debts. Number 3, money functioning as a store of value. That means it is an item that people can use to transfer purchasing power from the present to the future. Money as a store of value. That is, transfer purchasing power from the present to the future. So people may hold money, monetary assets. Wealth is defined as the total of all stores of value, including both money and non-monetary assets. Liquidity is defined as the ease with which an asset can be converted into the economy's medium of exchange. Different kinds of money include commodity money, that is, money that takes the form of a commodity with intrinsic value. That is, the item would have value even if it were not used as money. For example, would be gold coins, cigarettes that were used in prisoner of war camps. The fiat money, on the other hand, is money without intrinsic value and is used as money because of government decree. For example, the US dollar is a fiat money. Money in the United States economy, what we call money stock, that is the quantity of money circulating in the economy. And that includes the currency, which is paper bills and coins in the hands of non-bank public. Money stock also include demand deposits, that is balances in bank accounts that depositors can access on demand by writing checks. So the money stock would be M1 as of July 2019. There was $3.8 trillion in M1, that is currency, demand deposits, travelers' checks, and other checkable deposits. As of the same date, M2, which is a broader definition of money, that was circulating was $14.9 trillion. M2 is everything in M1 plus savings deposits, small time deposits, money market mutual funds, and a few minor categories. The distinction between M1 and M2 will often not matter when we talk about the money supply in this course. Active learning, M1 and M2. Suppose the entire economy has $150 kept in coffee cans and wallets, 300 in savings accounts, 200 in credit card debt, credit card limits, 20 in travelers' checks, $350 in checking accounts, $400 in money market mutual funds. Calculate M1 and M2. M1 includes currency plus demand deposits plus travelers' checks plus other checkable deposits. And that would be 150 plus 350 plus 20, and that would be 520, M1. M2 is equal to M1 plus savings deposits plus small time deposits plus money market mutual funds plus a few minor categories. In this example, M2 would be 520, which is what was in M1, plus 300, plus 0, plus 400, plus 0, and that is 1220. The Federal Reserve System. The Federal Reserve, popularly referred to as the Fed, is the central bank of the United States. So what's a central bank? Central bank is an institution designed to oversee the banking system and regulate the quantity of money in the economy. The Fed's organization. The Federal Reserve System consists of the Board of Governors, which is 7 members that serve for a 14-year term. It's located in Washington, D.C. The chairman is called Jerome Powell. There's the chair of the Fed appointed in 2018. Then there are 12 regional Federal Reserve banks located around the United States. The Fed's jobs. Number 1, regulate banks and ensure the health of the banking system. It monitors each bank's financial condition. It facilitates bank transactions, that is clearing of the checks. A bank's bank, that means it makes loans to banks, a lender of last resort. Monetary policy by the FOMC, another Fed's job. It controls the money supply, quantity of money available in the economy. Controlling money supply is perhaps the most important function of the Fed. Federal Open Market Committee, or FOMC. FOMC, all the 7 members of the Board of Governors sit on the FOMC, and 5 of the 12 regional bank presidents. All 12 regional presidents attend each FOMC meeting, but only 5 get to vote. Open Market Operations, or OMO. This is the buying U.S. government bonds to increase the money supply, sell U.S. government bonds to decrease money supply. Bank reserves. Fractional reserve banking system. That means banks keep a fraction of deposits as reserves and use the rest to make loans. The Fed establishes reserve requirements. These are regulations on the minimum amount of reserves that banks must hold against deposits. The banks may hold more than its minimum. The reserve ratio, or R. This is the fraction of deposits that banks hold as reserves. Total reserves as a percentage of total deposits. That is how you calculate the reserve ratio. Let's look at a typical T account. T account is a simplified accounting system that shows a bank's assets and liabilities, and they show it side by side. The bank here is called the First National Bank, with the liabilities on the right-hand side and assets on the left-hand side. As you can see on the liability sides are depositors. These are the depositors' money. And what do they do with that money? They keep some as reserves and give out some as loans. Banks' liabilities include deposits, assets include loans and reserves. Notice that R is equal to 10 over 100, which is 10%. Example 1, changes in money supply. Suppose $1,000 of currency is in circulation. To determine bank's impact on money supply, we calculate the money supply in three different cases. Number 1, no banking system. Number 2, 100% reserve banking system. That means banks hold 100% of deposits as reserves and they make no loans. And number C, fractional reserve banking system with reserve ratio of 20%. Solution A, there's no banking system. The public holds 1,000 as currency. Money supply is 1,000. Number B, Number B, 100% reserve banking system. Public deposits 1,000 at First National Bank, FNB, and on the deposit side is 1,000, on the asset side is 1,000. If FNB holds 100% of deposits as reserves, money supply is exactly equal to currency plus deposits, which is equal to 0 plus 1,000, which is equal to 1,000. In a 100% reserve banking system, banks do not affect the size of money supply. C. Fractional reserve banking system with reserve ratio equal to 20%. First National Bank loans all but 20% of the deposit to Isabella. So we look at the First National Bank transaction. The first deposit come in at 1,000, and the bank gives out a loan of 800 and must keep 200 as required reserves. The depositors have 1,000 in deposits. Isabella borrows the 800 in currency. Money supply is now equal to currency plus deposits, which is equal to 800 plus 1,000, which is 1,800. How did the money supply suddenly grow? When banks make loans, they create money. Isabella, the borrower, gets 800 in currency, an asset counted in money supply. $800 in new debt, that is loans. A liability that does not have an offsetting effect on the money supply. A fractional reserve banking system creates money but not wealth. C. Fractional reserve banking system. Isabella deposits $800 at Second National Bank, so SNB's T account looks like the $800 from Isabella is a deposit, and though the reserves at Second National Bank is 800, With a reserve ratio of 20%, the Second National Bank, for Second National Bank, it will loan all but 20% of the deposit to Kerem, and its T account will change. So here, the deposit from Isabella is 800. The reserve, which is 20% of 800, that is required reserve, and the loan given to Kerem, I think, is $640. Fractional reserve banking system. Kerem's SNB's, which is the borrower, deposits this 640 at the Third National Bank. So TNB's T account look like this. So Kerem's 640 deposited at the Third National Bank is a liability, that's a deposit. And it is double entry reserves on the asset side. And so, with the reserve ratio is equal to 20% for TNB, it will loan all but 20% of the deposit to Dahlia, and its T account will change. So this is Third National Bank with Kerem's deposit and reserves of 128, and the loan given to Dahlia of 512. The process continues, and money is created with each new loan. The original 1,000 came in, then lending 800 was given, and this 800 went to another bank, which created money. Then 640 was given, then 512 was given. The total money supply is now $5,000. In this example, 1,000 of reserves generates $5,000 of money. The money multiplier. The formula for money multiplier is the ratio of 1 to R, or 1 over R. The amount of money the banking system generates with each dollar of reserves is the reciprocal of the reserve ratio. The higher the reserve ratio, the smaller the money multiplier, because the less of each deposit banks loan out. Active learning 2, banks and the money supply. While cleaning his apartment, Hakim finds a $50 bill under the couch. He deposits the bill in his checking account at Chase Bank. The Fed's reserve requirement is 10% of deposits. What is the maximum amount that the money supply could increase? Number B, what is the minimum amount that the money supply could increase? Number C, how would you answer A and B? How would your answer to A and B change if reserve ratio is 5%? Answer to number A. With a reserve ratio of 10%, Hakim deposits $50 in his checking account. Number A, maximum increase in money supply. If bank hold no reserves, then the money multiplier is 1 over R, or 1 over 0.1, or 10. The maximum possible increase in deposits is 10 times 50, which is equal to 500. But money supply also includes currency, which falls by 50%. Hence, the maximum increase in money supply is 450. Number B, a reserve ratio of 10%, Hakim deposits 50 in his checking account. The minimum increase in the money supply is 0. That means if Chase Bank makes no loans from Hakim's deposit, the currency falls by 50, deposits increase by 50, money supply does not change. When banks hold all deposits in reserves, banks do not influence the supply of money. Answer to C. If reserve ratio is 5%, Hakeem deposits $50 in his checking account. Maximum and minimum increase in money supply if reserve ratio is 5%. Money multiplier increases to 20. If banks hold no excess reserves, the maximum increase in money supply is new deposits, or 20 times 50. Currency is 50, so the answer is 950. If banks keep all deposits in reserve, the change in money supply is zero, regardless of the reserve ratio. A more realistic balance sheet. Assets, these are reserves and loans and securities, which include stocks and bonds. Liabilities, these are deposits, debt, and equity. Bank capital, that is owner's equity. The resources a bank obtains by issuing equity to its owners. This equals bank assets minus bank liabilities. Leverage, the use of borrowed funds to supplement existing funds for investment purposes. Example 2a, a more realistic balance sheet. A more realistic national bank would have on the liabilities side deposits of $1,500, debt of $400, capital of $100. On the asset side would be reserves of 400, loans of 1,000, and securities of 600. Leverage ratio is 2,000 divided by 100. Leverage ratio is 2,000, which is the total of assets, divided by the equity, which is 100. So the leverage ratio is 20%. So for every dollar in assets, $1 is from the bank's owners, 19 is financed with borrowed money. If bank assets appreciate by 5% from 2,000 to 2,100, bank capital increases from 100 to 200, doubling owner's equity. If bank assets decrease by 5% from 2,000 to 1,900, the bank capital falls from 100 to 0. If bank assets decrease more than 5%, the bank capital is negative and the bank is insolvent. Capital requirement. This is a government regulation that specifies a minimum amount of capital. It is intended to ensure banks will be able to pay off depositors and debts. The financial crisis of 2008-2009. Banks find themselves with too little capital to satisfy capital requirements. That led to credit crunch, which is the shortage of capital induced the banks to reduce lending. The Fed's tools of monetary control. The Federal Reserve banking. Banks create money. The Fed's control of the money supply is indirect. Money supply is equal to the money multiplier times bank reserves. The Fed can change the money supply by changing quantity of reserves, changing the reserve ratio, and money multiplier. Capital requirement. Government regulation that specifies minimum amount of capital intended to ensure banks will be able to pay off depositors and debts. The financial crisis of 2008 2009. Banks find themselves with too little capital to satisfy capital requirements, which led to credit crunch. The shortage of capital induced the banks to reduce lending. Fractional reserve banking. Banks create money. The Fed control of the money supply is indirect. Money supply is equal to money multiplier times bank reserves. The Fed can change the money supply by changing the quantity of reserves, changing the reserve ratio and money multiplier. Open market operations. Open market operations, or OMOs, the purchase and sale of U.S. government bonds by the Fed. To increase bank reserves and the money supply, the Fed buys a government bond from a bank, pays by depositing new reserves in the bank's reserve account. With more reserves, the bank can make more loans, increasing the money supply. Fed lending to banks. Banks borrow from the Fed's discount window, paying an interest rate called the discount rate, increasing reserves in the banking system and increasing the money supply. If the Fed lowers the discount rate, this encourages banks to borrow more, increasing the quantity of reserves and the money supply. Term auction facility, new as of 2007 to 2010. The Fed assets. The Fed sets a quantity of reserves it will loan. Then banks bid against each other for these loans. Fed helps financial institutions in trouble. The Fed lends to banks not only to control the money supply, but also to help financial institutions when they are in trouble. In 2008 and 2009, a fall in housing prices throughout the US, sharp increase in mortgage defaults, and many financial institutions holding those mortgages ran into trouble. The Fed provided many billions of dollars in loans to financial institutions in distress. How the Fed influences the reserve ratio. The Fed sets reserve requirements. Regulations on the minimum amount of reserves bank must hold against deposits. Reducing reserve requirements would lower the reserve ratio and increase the money multiplier. Paying interest on reserves since October '08. When banks hold reserves at the Fed, raising this interest rate would increase the reserve ratio, lowering the money multiplier and lowering the money supply. Problems in controlling money supply. The Fed does not control the amount of money that households choose to hold as deposits in banks, the amount that bankers choose to lend. Yet the Fed can compensate for household and bank behavior to retain fairly precise control over the money supply. Case study: bank runs and the money supply. A run on banks. If people suspect their banks are in trouble, they run to the bank to withdraw their funds, holding more currency and less deposits. Under fractional reserve banking, banks don't have enough reserves to pay off all depositors. Banks may have to close. Also, banks may make fewer loans and hold more reserves to satisfy depositors. These events increase reserve ratio, reverse the process of money creation, cause money supply to fall. In 2007, bank run in the UK was witnessed. Northern Rock Bank was eventually taken over by the British government. During 1929 to 1933, a wave of bank runs and bank closings caused money supply to fall by 28%. Many economists believe this contributed to the severity of the Great Depression. Since then, Federal Deposit Insurance (FDIC) helped prevent bank runs in the United States. A more stable banking system was the result. Federal funds rate. The federal funds rate is an interest rate at which banks make overnight loans to other banks. The lender has excess reserves and the borrower needs that reserves. Decisions by the FOMC to change the target for the federal funds rate are also decisions to change the money supply. A decrease in the target for federal funds rate means an expansion of money supply. The federal funds rate and other rates from 1969 to 2019. The monetary policy is a graph of the federal funds market with federal funds rate on the vertical axis and quantity of federal funds on the horizontal axis. To raise the federal funds rate, the Fed sells government bonds. This removes reserves from the banking system and reduces supply of federal funds rate. You can see a left shift of the supply curve, causing R to rise, federal funds rate to rise from $1.50% from 150% to 1.75%. Think, pair, and share. Suppose you are a personal friend of the chair of the Board of Governors of the Federal Reserve System, Jerome Powell, 2019. He comes over to you, to your house for lunch, and notices your couch. He is so struck by the beauty of your couch that he simply must have it for his office. He buys it from you for $1,000. And since it is for his office, he pays you with a check drawn on the Federal Reserve Bank of New York. Number A, are there more dollars in the economy than before? Why or why not? Number B, why do you suppose that the Fed doesn't buy and sell couches, real estate, and so on instead of government bonds when they desire to change the money supply? Number C, if the Fed doesn't want the money supply to rise when it purchases new furniture, what might it do to offset the purchase? Chapter in a nutshell. Money, assets that people regularly use to buy goods and services. Three functions include medium of exchange, unit of account, and store of value. Commodity money has intrinsic value. Fiat money, such as paper dollars, is money without intrinsic value. Money in the US economy, there is currency and bank deposits, such as checking accounts. The Federal Reserve, the central bank of the United States, is responsible for regulating the US monetary system. The Fed chair is appointed by the president and confirmed by Congress every 4 years. The chair is the head of the Federal Open Market Committee, which meets about every 6 weeks to consider changes in monetary policy. Bank deposits provide resources to banks by depositing their funds into bank accounts. These deposits are part of a bank's liabilities. Bank owners also provide resources called bank capital for the bank. Because of leverage, the use of borrowed funds for investment, a small change in the value of bank's asset can lead to large change in the value of bank's capital. To protect depositors, bank regulators require banks to hold a certain minimum amount of capital. The Fed controls the money supply. Open market operations, the purchase of government bonds increase the money supply, and the sale of government bonds decrease the money supply. We can expand the money supply by decreasing the discount rate, increasing its lending to banks, lowering reserve requirements, or decreasing the interest rate on reserves. When individuals deposit money in banks and banks loan out some of these deposits, the quantity of money in the economy increases. Because the banking system influences the money supply in this way, the Fed's control of the money supply is imperfect. The Fed has, in recent years, set monetary policy by choosing a target for the federal funds rate, a short-term interest rate at which banks make loans to one another. As the Fed pursues its target, it adjusts the money supply.